The S&P 500 has opened very mixed today, but our focus is going to be on an industry that hasn't had much love over the last few months. It is the oil and gas. We have some of these big names that are down. Chevron, in fact, down 8%. Phillips down another 8%. Oxy, one of Warren Buffett's favorite, down 11%. And also just to bear in mind that a lot of analysts who do see Trump taking power over the next few months do in fact believe that out of the top 10 best stocks that will perform very, very well, both Chevron Corporation as well as Exxon Mobile are the top two. Now, we won't go into that in much detail. In fact, what we're going to focus our attention on today is the big six in the oil and gas. We're going to look at each one's historical performance. We're also going to talk about the movement that we've seen in their previous quarterly earnings, as well as expectations moving forwards. We're going to cover their dividend safety at just a very high level. And as always, with each one of these, we're going to discuss what our intrinsic value is, what the Wall Street upside is, as well as the margin of safety. Now, we are kicking off firstly with Chevron Corporation, which does trade right there towards its 52-week lows. It is a double buy signal according to Seeking Alpha and Wall Street, with a hold from Quant and a very nice starting forward yield at 4.51%. In terms of forward P, it sits at 12.5. For context, S&P right now at 23. Over the last year, it is down around 9%, and over the last 10 years, it is only up around 13%. Not the greatest return. Bear in mind as well, this doesn't include dividends reinvested. And for example, if you had bought this at the COVID lows of around $59 in 2020 March, you would be up, in fact, more than double. Now, we also want to just run through their earnings, how they've performed historically, and in fact, over the last 4 quarters, they did have a double beat and a double miss, so that is in fact a 50% track record, with the more recent quarter being a fairly substantial miss. Now, moving forwards, over the next 2 quarters, they are anticipating decreases to the EPS year on year, although the subsequent 2 we can see some growth, and ultimately by the end of next year, their earnings per share estimate is expected to increase, with their forward P coming down to around 10.52. As we said as well, very briefly, their dividend safety score does sit at 90, which is very safe, so nice to note. And in fact, their dividend growth was 7.9% in February this year. Nice to see, mid to high single digit increase. And as always, on this channel, we do want a bare minimum of 4%, just to keep up in line with inflation. Now, the intrinsic value in today's episode does come to $180. Now, we won't run through every single model in detail, but typically on this channel, when we do our deep dives, we run through them, discuss the inputs and outputs. Our 180 intrinsic value, not dissimilar from Wall Street, where they have a target of 181 and they see 23% upside. Now, in terms of margin of safety on this channel, we always start off with 10% and we execute on this if it meets that 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, a buy up to $162, then we keep going till it's near the current trading price, and in today's episode, not quite at the 20% level just yet, sitting between 15 to 20% with upside of 23%, and bear in mind it does have a nice starting yield, as well as the fact the growth does look fairly favourable. As we go along, as always, do give us your thoughts in the comments below. Before we move on, we just want to point out we have released our latest free weekly article where we run through some very big investors, what they've bought and sold over the last few months. If you want access to that as well as any other articles, it is completely free and you can grab a copy by clicking on the pinned comment below. And you will also get access to 35 undervalued stocks for your consideration in August, where we also detail those that sit within our own portfolio, so do go check that out. The next oil and gas giant is Exxon Mobile Corporation, with a double buy and a hold from Quant. It is trading in the mid to upper end of the 52-week range, a yield of 3.32%, so it is lower than what we just saw for Chevron, and we do note a higher forward P around 13.5. Now, over the last year, it is up around 6%, and we can see over the last 10 years, similar to Chevron Corporation, very minimal growth, up 15%, but as always, will depend on when you acquired them. Now, in terms of the EPS, well, again, very similar. They do have, in fact, a double beat and a double miss. However, what's interesting to note, in their more recent quarter, we see that Exxon Mobile actually beat by around 13 cents. Moving forwards, the next 2 negative growth, with the subsequent 2 being positive, and as we can see, their December EPS estimate of $9.34 will lower that forward P to 12.26. Now, we don't get a very safe dividend score, we just get the 80 safe. Nonetheless, that is still positive, and we can see in October last year, they did increase that dividend just marginally higher than the inflation rate that we want to see of 4%. Now, in terms of their intrinsic value, and as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. 125 then is lower than Wall Street. They sit higher at 135 with upside of 18%. So when we do run it through the MOS calculation at 10%, it isn't that far off. So we see a near 10% MOS with Wall Street seeing 18% upside. So if you're purely looking at it from a valuation perspective, so far just the first two we've gone through, it does look like Chevron Corporation seems to be the better buy currently. We then move on to BP with just a buy from Wall Street and a double hold from Seeking Alpha from Quant. Another one like Chevron Corporation trading right there towards the 52-week low. It does have the highest yield so far, 5.4%, with one of the lowest forward Ps in the industry at 7.98. Now, over the last year, not great, negative 8%, and when we do go over the last 10 years, the first one that actually has had a negative return, negative 30%. Now, in terms of their earnings, nice to see the last three quarters, they did beat or at least in line. However, when we do go back to quarter three, they did miss by 19 cents. Moving forwards though, it is only the next quarter where they anticipate decrease to the earnings per share. Moving forwards, as we can clearly see, they are expecting growth, with December 2025 5.01 EPS estimate, lowering that forward P even further to 6.67. We do, however, note their dividend safety score does sit at borderline safe 50, although just last month they did increase that dividend at a double-digit rate, 10%. Always love to see this on the channel. And when we take a look at their valuation, well, $44, pretty much spot on with what Wall Street see, with 31% upside, the most so far. And when we take a look at the MOS, well, 10% a buy at $39, at 15% a buy at $37. And as we keep going, we can see in today's episode, not far off a 25, sitting somewhere between 20 to 25, making it the most attractive option on the valuation model as of right now. Don't forget as well, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for BP or any other company that you wish. We then move on to Shell, which has been one of the best performing in the industry, with a double buy Seeking Alpha Wall Street, although a regular hold from Quant. It is trading at the upper end of the 52-week range, very similar to Exon Mobile, with a yield of 3.82% and a forward P of 8.6. Over the last year, it is up around 16%, and when we do look at their earnings, well, the last three quarters they did beat with a miss in Q3. Moving forwards, we have 2 growth expected with 2 decreases to the EPS, although the earnings estimate for 2025 still shows an increase, with the forward P coming down marginally to around 8.5. Now, when we look at the dividend safety, another one with borderline safe score, and just this year we did have a fairly mediocre increase of 3.9%. Now, in terms of the valuation, well, our intrinsic value of $85, not too far off Wall Street's $84.30. They see 17% upside, and when we do look at a MOS, well, 10% a buy at $76, and at 15% pretty much where the company is at right now at $72 mark. So you could argue maybe this is one of the more higher quality in the industry. They performed very well over the last 12 months. 15% MOS with 17% upside. And as always, do give us your thoughts below. We then move on to one that Warren Buffett continues to add to his own portfolio, Occidental Petroleum. Now, we actually get a triple hold right across the board. This one is trading right there at its 52-week low with a yield of 1.6%, so the lowest today, and a forward P, in fact, one of the highest at 15. Now, over the last year, it is down around 12%. Over the last 10 years, down 43%. So definitely the worst performing over the last 10 years. And when we do look, very nice to see over the last 4 quarters, 100% track record, beaten analyst targets. Moving forwards, just one decrease noted next quarter, with the subsequent 3 looking positive. And in fact, their EPS estimate of 4.67 in 2025 will bring that forward P down to 12.04. Now, we do get a continual borderline safety score sitting at 60, although they did rapidly increase their dividend in December last year at 22%. Now, in terms of the valuation, we have an intrinsic value of $75, Wall Street at 72, so that is some significant upside at 29%. And when we do run it through the MOS, well, 10% a buy at $67, at 15% at 64, and we can see in today's episode, similar to BP, a very large MOS, 25% with Wall Street at 29% upside. Let us know, this may be one that you are considering to buy. It has dropped over the last few months. We then move on to ConocoPhillips with our first triple buy rating right across the board. Another one trading towards its 52-week lows with a yield of 3.2% and a forward P sitting just below 13. Now down around 6% over the last 12 months. Over the last 10 years, the first one that we actually see up a fairly respectable 43%, although obviously we do want it to be a lot higher. The previous ones have been very, very low. Now when we take a look at the earnings, well, over the last 4 quarters, at a bare minimum, we have an inline with it 3 of them being beats, so a nice record there. Moving forwards though, as we see the next 2 quarters expected decreases to the EPS, and we can clearly see with a 9.92 EPS expected, forward P will be lower to around 11.07. We then get to their dividend safety where we have a 61 safe score, and very, very nice to note, 14% double-digit increase November last year. We then put it through the intrinsic value calculation at a $139 intrinsic value, still marginally lower than Wall Street's 146 where they have 32% upside. We then get the MOS, well at 10% a buy at 125, 15% at 118, and in today's episode, pretty much a 20% margin of safety, 32% upside from Wall Street, and as we saw, the first oil and gas where we got that triple buy rating right across the board. As always, if you do enjoy today's episode, smash that like button, hit that subscribe and bell button so you're continually notified as these videos drop. Also, don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and also joining us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.